In August 2024, a federal class action lawsuit revealed that one of the largest RV financing companies in the United States was systematically marking up interest rates by an average of 2.3 percentage points above what customers qualified for. The company would tell you that you were approved at 8.9% interest when the actual lender had approved you at 6.6%. That difference, multiplied across a $70,000 loan over 15 years, equals an extra $18,000 in interest payments that goes directly into the dealer's pocket as a kickback from the finance company. If you walk onto an RV dealership lot today and the sales manager offers to help you with financing, you are about to enter one of the most predatory lending environments in consumer finance. The recreational vehicle industry has perfected a system where the finance company, the dealership, and the extended warranty provider all profit from your lack of knowledge about how RV loans work. And the interest rate you are quoted has almost nothing to do with the rate you qualify for. In January 2025, consumer protection researchers analyzed over 8,000 RV loan contracts originated between 2022 and 2024. The data revealed that customers who financed through dealership-arranged lenders paid an average of 3.1 percentage points more than customers who secured their own financing through credit unions before walking onto the lot. We are talking about the difference between a 6% interest rate and a 9.1% interest rate on the same credit profile. Over the life of a typical RV loan, that difference represents tens of thousands of dollars transferred from your bank account to the dealership and the finance company. The Dealer Reserve System. To understand why certain RV lenders are traps, you need to understand a practice called Dealer Reserve. This is the legal but deceptive system that allows dealerships to mark up your interest rate and keep the difference as profit. Here is how it works. You fill out a credit application at the dealership. The finance manager submits that application to multiple lenders. Let us say you have good credit, and the lender approves you for a loan at 6.5% interest. The lender gives the dealer permission to offer you any rate between 6.5% and 10.5%. That 4-point spread is called the dealer reserve, and every fraction of a percent above 6.5% that the dealer convinces you to accept becomes profit for the dealership. The finance manager now has a decision to make. He could offer you the 6.5% rate that you were approved for and make no additional commission. Or he could tell you that based on your credit, the best rate available is 9.5% and you would never know the difference. If he quotes you 9.5% and you sign the contract, the lender pays the dealership a kickback equal to 3 percentage points on the total loan amount. On a $60,000 loan, that 3-point markup generates approximately $10,000 in additional profit for the dealership over the life of the loan. And this is completely legal in most states because the finance manager never lied to you. He never said that 9.5% was the lowest rate the lender approved. He just said it was the best rate available, which is technically true if you define available as the rate he is willing to offer you. Some states have implemented laws capping dealer reserve at 2 percentage points, but enforcement is inconsistent, and many dealers ignore the limits because the penalties are minimal compared to the profit. Number 1. Good Sam Finance Center. Good Sam Finance Center is the lending arm of Camping World, the largest RV dealership chain in the United States. On the surface, financing through Good Sam seems convenient. You are buying your RV from Camping World, and they offer in-house financing that can get you approved the same day. But that convenience comes at a steep cost. Good Sam Finance operates on a business model that prioritizes loan origination volume over competitive rates. According to data from consumer lending comparison sites, Good Sam's average interest rates run 1.5 to 2.5 percentage points higher than credit unions for borrowers with similar credit profiles. A borrower with a 720 credit score might get quoted 8.9% from Good Sam when a credit union would offer the same person 6.5%. The reason for this markup is that Good Sam makes money 3 different ways on your loan. First, they earn interest on the loan itself. Second, they earn dealer reserve from marking up your rate. Third, they bundle extended warranties and service contracts into the financing, earning additional commission on those products. The extended warranty bundling is particularly insidious. The finance manager will present you with a monthly payment that includes the RV price, the interest, and a $6,000 extended warranty. They structure the conversation around the monthly payment rather than the total cost, so you do not realize you are financing a warranty that is worth a fraction of what you are paying for it. Good Sam also offers longer loan terms than most lenders, regularly writing 20-year loans on depreciating assets. A 20-year loan on an RV means you will be underwater on the loan for at least 12 to 15 years. If you need to sell the RV before the loan is paid off, you will owe more than the RV is worth, and you will have to bring cash to the closing table just to get out of the loan. Number 2. Lightstream by Truist Bank. Lightstream markets itself as an online lender, offering competitive rates on RV loans with no dealer involvement. Their advertising emphasizes low rates, no fees, and fast approval. And for borrowers with excellent credit, their rates can be competitive. But Lightstream has a hidden trap that destroys many borrowers. Lightstream offers unsecured RV loans, meaning the RV itself is not collateral for the loan. This sounds like a benefit because it means they cannot repossess your RV if you default. But the reality is far more dangerous. Because the loan is unsecured, Lightstream compensates for the higher risk by building prepayment penalties and yield maintenance fees into their loan structure. If you pay off the loan early, you may owe a substantial penalty that negates any benefit from refinancing or paying down the principal faster. More importantly, because the loan is unsecured, you do not get the same consumer protections that apply to secured vehicle loans. If the RV turns out to be a lemon and you want to return it under your state's lemon law, the fact that the loan is not secured to the vehicle complicates the legal process significantly. Lightstream also requires excellent credit to qualify for their advertised rates. The 5.99% rate you see in the advertisement applies only to borrowers with credit scores above 780 and high income-to-debt ratios. If your credit score is 680, which is still considered good credit, Lightstream may quote you 11% or simply decline your application. They use the low advertised rate to generate applications, then quote much higher rates to most applicants. Number 3. Dealer-arranged financing from regional banks. Many RV dealerships have relationships with regional banks that specialize in RV lending. Names like Bank of the West, Essex Credit, and others appear frequently on RV loan contracts. These lenders are not inherently predatory, but the way dealerships use them creates a trap for uninformed buyers. The regional banks pay some of the highest dealer reserve commissions in the industry. A typical arrangement allows the dealer to mark up the rate by 3 to 4 percentage points and keep the entire spread as profit. This creates a situation where the finance manager has enormous financial incentive to quote you the highest rate you will accept rather than the lowest rate you qualify for. The trap becomes worse because these regional banks also finance the extended warranties, gap insurance, and other dealer add-ons. The finance manager structures a package deal where everything is rolled into one monthly payment. You think you are financing a $65,000 RV at 8.5% interest, but the contract shows a loan amount of $82,000 because they included a $7,000 extended warranty, a $3,500 gap insurance policy, a $4,000 tire and wheel protection plan, and $2,500 in dealer fees. You are now paying interest on products that are worth a fraction of their listed price. The extended warranty that costs $7,000 has a dealer cost of approximately $2,000. You are financing the $5,000 markup at 8.5% interest for 15 years. When customers realize they were overcharged and try to cancel these add-ons, they discover the cancellation process is deliberately difficult. The warranty company requires written cancellation requests sent by certified mail. They take 60 to 90 days to process the refund, and the refund is prorated, meaning you only get back a portion of what you paid because they claim you already received value from having the coverage. Number 4. Credit Acceptance Corporation. Credit Acceptance Corporation specializes in subprime lending for borrowers with damaged credit. They advertise that they can get you approved when other lenders say no, and they can because they charge interest rates that would make a credit card company blush. Credit Acceptance regularly writes RV loans with interest rates between 18% and 24% for subprime borrowers. On a $50,000 loan at 22% interest over 15 years, you will pay over $105,000 in interest. Your total repayment amount will exceed $155,000 for a vehicle that will be worth $15,000 by the time the loan is paid off. The payment structure is designed to keep you trapped in the loan. Credit Acceptance front-loads the interest, meaning your early payments go almost entirely toward interest with minimal principal reduction. After making payments for 3 years, you might have only reduced the principal balance by $4,000 while paying $18,000 in payments. If you try to refinance or pay off the loan early, you discover that Credit Acceptance has structured the loan to maximize the total interest they collect. Some of their contracts include yield maintenance provisions that require you to pay a substantial portion of the future interest, even if you pay off the principal early. Credit Acceptance also reports to credit bureaus in a way that makes it difficult to improve your credit score even with perfect payments. They report the loan as a high-risk account, which limits the positive impact of your payment history on your credit profile. Number 5. Camping World's in-house We Finance Anyone program. When Credit Acceptance and Good Sam turn you down, Camping World dealerships offer a final option: their in-house portfolio lending program, marketed under slogans like "We Finance Anyone" or "Guaranteed Approval." This is not financing in the traditional sense. This is a lease-to-own arrangement disguised as a loan. The dealership keeps the title. You make weekly or bi-weekly payments. And if you miss a single payment, they can repossess the RV immediately without going through the legal process required for secured loans. The effective interest rate on these arrangements often exceeds 30% when you calculate the total cost of ownership. A $40,000 RV might require payments totaling $85,000 over 7 years before you receive the title. During those 7 years, you cannot sell the RV, you cannot refinance, and you cannot move to another state without dealership permission because they hold the title. These arrangements prey on buyers who have been rejected by traditional lenders and are desperate to get into an RV. The dealership knows the buyer will probably default within 2 years. When that happens, they repossess the unit, keep all the payments, and sell the same RV to another subprime buyer. One RV can generate profit from 3 or 4 different buyers over its lifetime. The correct way to finance an RV. If the 5 lenders we have exposed represent traps, what is the correct path forward? The answer is to secure your own financing before you ever walk onto a dealership lot. Credit unions consistently offer the lowest RV loan rates in the industry. A member of Navy Federal Credit Union, Pentagon Federal Credit Union, or even a local community credit union can often secure rates 2 to 3 percentage points lower than dealer-arranged financing. Credit unions are not-for-profit institutions that return their earnings to members in the form of lower rates and better terms. The process is straightforward. You join the credit union by opening a savings account with a small deposit. You apply for pre-approval on an RV loan. They provide you with a pre-approval letter stating the maximum amount you can borrow and your interest rate. You take that letter to the dealership and tell them you have your own financing. The dealership finance manager will try to beat your rate. This is fine. Let them try, but you now have a baseline to compare against, and you know they have to offer something better than what your credit union provided. The dealer reserve system works in your favor when you have leverage. For buyers with excellent credit, consider using a home equity line of credit if you own a home with available equity. HELOC rates are typically lower than RV loan rates because your home secures the loan. The interest may also be tax deductible if you use the funds for home improvements, though you should consult a tax professional about your specific situation. For buyers who cannot qualify for traditional financing, the answer is not to accept predatory rates. The answer is to wait until you can improve your credit or save a larger down payment. An RV is a luxury purchase, not a necessity. No one needs to accept a 22% interest rate on a depreciating asset that will financially ruin them. The bottom line: the RV financing industry is built on information asymmetry. The lenders and dealerships profit when you do not understand how dealer reserve works, how interest compounds over long loan terms, and how much cheaper credit union financing can be. Before you sign any RV financing contract, get pre-approved by at least 2 credit unions. Compare the rates, terms, and fees. Read the entire contract, including the fine print about prepayment penalties and default provisions. Calculate the total amount you will repay over the life of the loan, not just the monthly payment. If the finance manager pressures you to sign immediately, walk away. If they claim the low rate is only available today, walk away. If they refuse to provide a copy of the contract to review before signing, walk away. The dealership will still be there tomorrow. The RV will still be available. And if it is not, there are thousands of other units on the market. Your financial future is worth more than the convenience of driving home in an RV today with a loan that will haunt you for the next 15 years.